Welcome, everyone, those of you who are physically here, and also those of you who are attending virtually. We're very pleased to have this event, launching this book, which we have available in paper here, but the Bruegel Institute has a copy available on the website in PDF form for free. So those of you who are not here, please, you can find that on the website. On behalf of the Center for European Reform, in cooperation with the good friends and colleagues at the Bruegel Institute, we're very happy to have Nicolas Véron here. For those of you who don't know him, he is a graduate of the École Polytechnique in the École de Mines in Paris. He spent some time in the French civil service, had a stint in the private sector, and then founded the Bruegel Institute, or was co-founder of the Bruegel Institute 20+ years ago. And he's now a senior fellow there. He's also a senior fellow at the Peterson Institute of International Economics in DC. So he has the rare distinction of being associated with two of the top three top three think tanks on either side of the Atlantic. So,
and in the middle.
and his research focuses on financial markets, financial regulation, and in particular, he's the leading expert on today's topic, the banking union. I will let him speak for about 10 minutes. I will have some questions, and afterwards we will have a Q&A session. So I hope that you will all participate actively. If you're attending virtually, you can submit questions through the chat, and we will. I will either let you speak, or I will read the question that you're asking. But and without further ado, I will just hand it over to Nicolas.
Thanks so much, Aslak. Thanks to Center for European Reform for co-hosting this and hosting it in the real world. And I'm always amazed by the both quantity and quality of the stuff you get out the way into the public debate. So it's a way for me. It's a good opportunity for me to pay tribute to the fantastic work that you've been doing, despite all the challenging environmental factors that we know. So I'm not going to speak very long in introduction. I encourage participants to read the book. The book was a labor of love for the last 2 years. The suggestion was initially made by my American boss, Adam Posen, well known in this town and in this building, to take a step back and look at the European Banking Union project after 10 years. That was in 22. I thought I could do it quickly and have the thing published in 22, and therefore it would be 10 years after the decision. Inevitably, it took some delay, so it's 10 years after the implementation, which was, of course, the entry into force of the single supervisory mechanism in November 2014. So I'm a bit ahead of time now. Jokes apart, it was very interesting for me, even after having worked a lot on this topic of banking union, to revisit, especially the early phases. There's a lot of historical research now based on accessible archives on the prehistory of banking union, so everything until and up to Maastricht. And it's a very interesting finding for me that this idea of a unified policy framework for Europe's banks has been there actually forever, since the 1960s. And that the first trace of it being envisioned by European policymakers in 65 or 66, if I remember correctly. Essentially, throughout that period, people in the business saw that eventually the European community or union would have a single banking supervisor, but that it was better not to talk about it too loud, because it was still contentious with a number of participants, including actually the treasury of my own country, France, which at the time of the Maastricht negotiation was the most vociferous opponent of European banking supervision. So then So I did amateur historian, standing on the shoulders of more competent historians in that first chapter of the book. And then I did amateur journalist in the next chapter of the book, which is about the sequence of decision in 2012. And I'm a bit humbled about talking about it here in the presence of José Leandro, who was there in the room where it happens, which I was not, so who can critically review what I wrote about it in the book. The funny thing when you do that is you interview plenty of people who were there, and they all give you a different version. So it's really kind of the Rashomon effect. So in the story I tell, for example, there's a big role of a young but talented advisor of newly elected president of France, François Hollande at the time. The young advisor is completely forgotten now. His name was Emmanuel Macron. And the thing is that a number of people who were in that meeting at Charles de Gaulle Airport tell me he wasn't there, because I don't remember him being there. Now, I believe he was there, and some of the people who were at that meeting remember him being there, even took notes of that. But to me, it really illustrates something that journalists have confirmed to me, which is when you do oral history, be prepared for a roller coaster, because you always get that, phenomenon of diverging memories. And so that was also a humbling experience. But basically, the story I tell, and the archive maybe will say one day whether it's exactly right or not exactly right, is that the deal was forged essentially between Schäuble and Macron in that conference room at Charles de Gaulle Airport, and that it was then endorsed by the Eurozone summit a few days later. And that deal was Germany saying, yes, we accept direct recapitalization of troubled banks by the ESM, the European Stability Mechanism, but we need for that to be plausible to have European banking supervision up and running. And then there were different contortions. The first one was when the leaders, basically Mrs. Merkel, imposed a time sequence in that by saying the single supervisory mechanism should come before the direct recapitalization. So the direct recapitalization would be retroactive, which was not what the lowers down had negotiated, including Schäuble. So there's a historical question which I don't answer, which is, did Merkel and Schäuble play a good cop, bad cop routine, or was Schäuble really disavowed by Merkel in that meeting? I don't know if, José, you have a view on the true answer to that question. I know some senior participants who don't have a view, they don't know. And then there was further backpedaling by the Germans, which ended up completely neutering the direct recapitalization piece, except for Ireland, which got a side deal with promissory notes, but I don't cover it in the book. Because essentially the job had been done by the announcement of single supervision, followed by the announcement by Draghi of OMT, and the crisis was resolved, and then why bother honoring the commitments if the crisis is solved? It's a rare example of a decision that was put in written form in the conclusions of a leader summit that was then backpedaled on by one of the main countries. I speak again under your control, José, but I don't think this happens very often. It's not maybe unique, but it's not very frequent. Okay, so that was the decision making. Then the next chapter is an assessment of the supervisory piece of the banking union, so what is known either as a single supervisory mechanism or European banking supervision. I prefer to call it European banking supervision, but who cares about the semantics? The assessment is extremely positive, so it works. The two caveats are, it works so far, so past is no guide for the future. And the second caveat is that it's not enough, because you need the other piece, which is crisis intervention, crisis management and resolution piece, and that's not done. But there's an interesting thing coming from the kind of long historical analysis, which is that before 2012, or before up until Maastricht, including Maastricht, there were very few, if any, people who thought that supervisory integration would not be enough. So people during that kind of early phase equated basically banking union, which they didn't call banking union, with supervisory integrations. They didn't see the need for parallel integration of the crisis intervention framework. With very few exceptions. Xavier Vives is one. There was also a couple of American guys who had experience of the savings and loan crisis, but most of the people who advocated banking policy integration thought that supervisory integration would be enough to do the job. Now we know it's not enough, and that's why the banking union is unfinished. And then the next session is about, in what sense is it unfinished? My point is to say it's not just the crisis intervention framework, it's also the challenge of concentrated sovereign exposures. We can discuss that in the Q&A. I don't want to be too long. And then the concluding section is about, what it would take to finish the job, and basically, the deal that would not be fiscal union, no safe assets, but would include a regulatory treatment of sovereign exposures, focusing on concentration risk, and of course, a European deposit insurance and also bells and whistles, would, in my view, do the job of completing the banking union, understood as breaking the vicious circle between banks and sovereigns, as it was defined in that famous summit in the early hours of June 29, 2012. So that's the book. Since the book was first published in PDF in June, the new event is UniCredit Commerzbank. I'm sure we will discuss that. So here we are with a fascinating cliffhanger just unfolding as we speak.
So thank you for that. So if those of you who are online, you can, if you want to have questions, if you have questions, you can raise a hand or submit the question to the chat.
Will we see if they raise their hands? Because on the big screen, we don't see them. I think you have them.
I have them here, so that's okay. But why don't we, since you raised the topic, why don't I ask you about Commerzbank and,
yes.
and UniCredit? Is this the kind of thing that could actually help promote the banking union? Is that you actually start with market participants helping create it? And also, if you could just mention briefly, if you think that this is something that Germany can stop if they want to.
So the first question, there's no doubt that banking union at this point, banking union can mean different things to different people. My definition of banking union is the one of the heads of state and government, which is to say banking union is breaking the vicious circle between banks and sovereigns. And there's a policy side to that, and there's a market side to that. So the policy side is to finish the policy job, which I describe in the book. So, this business of creating a single deposit insurance, dealing with concentrated sovereign exposures, that kind of things. And the market side is cross-border integration. So exactly what UniCredit is trying to do now. Andrea Henry, as a previous boss of European banking supervision, in his farewell interview with the Financial Times in, I think, November last year, said that not having cross-border consolidation was his single biggest disappointment after 5 years in the job. In a way, if this deal goes through, and I will explain why I believe it will eventually go through, it's kind of a vindication of the strategy, but a bit after Henry left under his successor, Claudia Bois. So the administrative response to your question, as far as I know, is that Germany has no levers to stop the deal other than just not selling its residual bunch of shares, but it has just sold 5% to UniCredit, ironically, so it still has about 12%, and it has signaled yesterday that it was not in a mood to sell them now. Minister Lindner this morning apparently said that they weren't selling now because some investors were, I think he said, unsettled by the UniCredit offer, which is a funny way to describe the current market situation. We'll see how it develops. But as far as I know, aside from competition policy, which in any case is independent in Germany, and shouldn't be a big deal anyway because of the geographical complementarity between Hypovereinsbank and Commerzbank, Also in Poland, by the way, because UniCredit sold its Polish bank, and therefore is not in competition with mBank, which is majority owned by Commerzbank. So the competition stuff should not be a big deal. And as far as I know, the only authorization procedure is in the hands of the ECB, which has no reason to block the combination unless there is something outside of the public domain that we don't know. So that's the kind of technocratic answer. Now, of course, you know, the politics matter. No bank wants to be, you know, in a hostile relationship with the government of an important host country. But another way to ask the question is, who do you think has more staying power, Andrea Orcel or Olaf Scholz? One of the more meaningful things that Orcel said this week is, we are very patient, I quote. So I think it depends a bit on your time horizon. I would be hesitant to predict that UniCredit will acquire majority ownership in the next few days. But I think if you take a medium-term horizon, this transaction is actually quite likely to proceed at least to majority ownership. Then there is a separate question whether, you know, it will be a full merger, but that's in a way an even longer horizon.
I read your book last week, and yeah, you were discussing the prospects for finishing the union, and you discussed it. Is it possible to do incremental reform, or do you need a crisis? So I was hoping you could. My question is, what are your thoughts on the immediate prospects for reform? Do we actually need a crisis? And the other is this? Could it be that could we live with the current state of affairs? Could we be in this sort of suboptimal equilibrium that could actually continue for quite some time?
So the answer to the second question is yes, we could. And it's not a particularly unstable equilibrium. Many people have said it's unstable because they've applied to this policy situation a scenario similar to the one we had during the Eurozone crisis. But the truth is the Eurozone crisis was a very intense crisis, and this typically doesn't happen very often. So as a policy analyst, I would like some event to force completion of the job. But if I try to be objective, I will say this is not a predictive statement, because it's a very plausible scenario in which you wouldn't have any energy into finishing the job, you wouldn't have a crisis for a very long time, and therefore we would live for a very long time with this halfway house. And actually what the Commerzbank approach by UniCredit, but even more importantly, the market reaction to the approach of UniCredit to Commerzbank demonstrates is that you can have cross-border M&A that meets market conditions, even in the current halfway house in policy terms. Now, is that good? I would say no, this is not good enough. And as a policy advocate, of course, I say this job should be completed. One thing that the Commerzbank story is demonstrating is that there is really no alternative discourse. I mean, basically, the German politicians who, for obvious reasons, don't like this deal, have absolutely nothing to say to justify their opposition to the deal. So they only have recourse to completely nonsensical things like saying the shareholders are dismayed by the approach, which is the opposite of the truth. With all due respect, of course, to Finance Minister Lindner, who is a very authoritative policymaker. And, you know, there has been even more absurd discourse, not by Lindner, saying, you know, this is bad for the Mittelstand, or the Italians are bad because they eat spaghetti with tomato sauce, and they have Italian debt, which actually is not even true, because UniCredit is, of all Italian banks, the ones with least exposure to the Italian sovereign, and they've always been careful about that. And so if one Italian bank is not going to be completely captured by the Italian Debt Management Office, it's certainly UniCredit. So I'm not saying you cannot paint a scenario in which their Italian headquarters would create a risk for German taxpayers, but conversely, you can paint a scenario in which their German exposures would create a risk for Italian taxpayers. And God knows there are issues in Germany these days. So you know, I mean, fun fact for you, maybe I mentioned that already to some of you, but UniCredit, as of late 23, has more assets in Germany than in Italy. So in terms of its balance sheet structure, it's more of a German bank than an Italian bank. And therefore, much of the narrative that you hear in Germany these days just makes simply no sense. It's, there is no argument, there is no plausible discourse against completing the banking union beyond that particular transaction. But there are many special interests in the public sector, in the private sector, and that creates enormous inertia.
I think we already have a few questions. People wanted to ask questions. So I think maybe I would ask David, you let's introduce yourself and then we can.
Thank you. Thank you. I'm Jose Leander. Thank you for this opportunity.
Present at the creation.
Yes, I was there. I was actually the economic advisor to President Van Rompuy. So I was sitting in a corner somewhere during these discussions when they took place. And that night was a momentous night, as Nicolas very rightly explains in the book.
So do you confirm that Macron was at Charles de Gaulle?
I wasn't at Charles de Gaulle. I don't know if Macron was there, but Macron was definitely during the Euro summit and that night. And I had several discussions with him in the margins of the meeting. But anyway, my point is that after this, I'm not sure that everyone around that table realized the weight and the importance of the decision that we're taking at that night. So, because at some point the discussions turned very technical with actual drafting of the text, Draghi very much involved in the drafting and all this. But just a small anecdote, the day after, so this finished early hours in the morning, and the day after, about 8 o'clock or so, Draghi texted President Van Rompuy and asked him from his car, "Can I see you?" And so he came to Van Rompuy's office, and he said to Van Rompuy, "Mr. President, you do realize how important this decision was, that the decision was taken last night." Van Rompuy said, "Of course, I do realize." And what happened afterwards is that a few days later, Draghi came to London and made the whatever it takes speech. And personally, I'm convinced that this decision that was taken at the European Council at the Euro Summit helped it to realize that, okay, this project has the highest support at the highest level. So he made that statement. So this is for I close the bracket here.
I have a follow-up question to you on that. But,
okay, I have two questions to you on what you just said at the beginning. One is on the banking union, and you mentioned the issue of, okay, banking union means a single supervisor and then cross-border consolidation. It also requires a deposit insurance mechanism, and some say it requires a regulatory treatment of sovereign exposures.
So including me.
Exactly. Now the question is, what about a European safe asset in that construction?
Exactly.
So that's what do you think? Do you think a regulatory treatment of sovereign exposures requires a prior agreement on a European safe asset? That's my first question. The second question is, very few people now talk about these issues, and actually the debate seems to have shifted to the capital markets here. So what do you think is more urgent, where the politicians and the leaders should spend their political capital? Is it on completing the banking union, or is it completing the CMU? Thank you.
You want to respond to that?
Yes, there's a lot to say about that. So, it's as you prefer.
Yeah, I think maybe you respond to that so we can keep the thread of the conversation, and then we have questions both from online and here. So.
Yeah. So, well, thank you, Jose. On the safe asset, the answer is in the book. So my recommendation is indeed the package deal, which includes a regulatory treatment of sovereign exposures and an integration of the crisis intervention framework. So there are two critiques of that package, which in a way are echoed in your question. One critique is you don't need the regulatory treatment of sovereign exposures to do the crisis intervention framework integration, which in a way was the logic of the European Commission's 2015 proposal for European Deposit Insurance Scheme, EDIS, because they proposed EDIS with a deadline for full mutualization initially, and without a regulatory treatment of sovereign exposures, which was being discussed, but not in the public domain at the same time. And the second critique, so that critique is basically your package is too much, you don't need the sovereign exposures piece. And the other critique is your package is too little, because you cannot do the sovereign exposures piece without the safe asset, which between us is kind of code for fiscal union. We can discuss the differences, but they're pretty insubstantial if you ask me. There are many threads to this conversation. I will try to make a long story short. The reason why I don't see the first critique as being valid, and I've evolved on this, is because essentially if you have a mutualization of the crisis intervention framework without restraint on essentially moral suasion of banks or on banks or financial repression so that member states can nudge their banks to buy their debt, it is very likely that the common safety net provided by the deposit insurance and more broadly the common crisis intervention framework will be subverted by some member states in the form of financial repression to get easier funding by their banks. And I think a regulatory treatment of sovereign exposure is the right way to counter that kind of moral hazard. So essentially, I take some of the German argument seriously because I think this risk exists on a policy level, aside from the question of political compromises and so on and so forth between the North and the South, the Brugels and blah, blah, blah. So I think there is a policy rationale for including a regulatory treatment of sovereign exposures, which again, but you know that for me only means concentration risk, so sovereign concentration charges. So German banks equally impacted as Portuguese banks or others. And I think this view actually has gained ground in a number of corners, including, for example, in the same peninsula as Portugal. When you discuss with Spanish policymakers, they have gone a long way from 10 years ago when it comes to this issue of sovereign exposure, just to give an example. Conversely, can you do a complete banking union without fiscal union? My answer is yes. And the reason for that is that any crisis intervention framework, short of full state ownership of the banking sector a la Chinese, is incomplete. And that's the case in all of our countries. If you look, I discovered that actually in recent years, but if you look at the framework for the FDIC in the US, which is everybody's reference, right? Because it kind of works, so last time it didn't work very well. The backing of the FDIC by the US government is actually limited. So essentially they don't have a full backstop. They have a limited backstop, which is defined in very unclear terms with a lot of obfuscation by legal devices which have never been tested. And essentially my argument is to say we can do that in the Eurozone. So we can have a deposit insurance framework which is well funded enough to be sufficient in almost any plausible crisis scenario. There will always be tail scenarios of crisis where it's insufficient, but this is best left to constructive ambiguity. And if you want to have a complete framework with unlimited fiscal backstop, actually you create moral hazard. And the reason I believe this discourse is plausible is that the US has not gone that far, and nobody has. So essentially, yes, you can create that kind of complete banking union without fiscal union. Now, of course, there are other views, and I know many people who disagree, including in a way the European Commission. The only public pronouncement I'm aware of from the European Commission on sovereign exposures is this 2017 communication where they essentially say that. They say sovereign exposures is okay, but only when we have a safe asset. Maybe you drafted that. But I think it would be good for the European Commission to rebalance their discourse and to bravely put sovereign exposures on the table the way they did in 2017 with deposit insurance, because I think that's the right balance. Now, again, open for discussion. On your second question, banking union versus capital markets union, for me, it's really like asking, you know, who do you love most, your dad or your mom? So I'm in favor of both, of course, completing the banking union and making a reality of the capital markets union, which for me, long story short, means also supervisory integration. So basically, you know, reforming ESMA and making it a genuine capital market supervisor for the entire European Union. Now, as much as I would love the completion of banking union, I see more of a political opportunity right now for the capital markets union piece. And that was illustrated in the Draghi report, but before that letter, and before that, I think more substantially the kind of awkward moment we had at the informal European Council discussion in April when Macron and Scholz came together and said, yeah, we will complete the capital markets union. The only problem is they didn't have a blueprint for that because their finance ministers hadn't worked together. So it was a complete failure in terms of creating a political dynamic, but it showed at least high-level political attention in those two countries, and they're not alone. So I think that demonstrates that you could potentially make a deal, and remember, this is qualified majority, so Luxembourg will oppose it, but cannot veto it, and the same with Ireland. So I think there is a possible deal, which is difficult, that's why it hasn't happened yet. It requires energy at the level of heads of state and government, not just finance ministers. It's made more difficult by the mess in France and in Germany, but it's not impossible. At this point, I don't see what could trigger a similar dynamic in banking union territory, and therefore my sequence would be to put all the chips in the immediate future, by which I mean this year, on essentially ESMA 2.0, and leaves the completion of banking union for a bit later. So that would be my kind of reluctant recommendation. Now, my question to you is on this point you mentioned of time sequence and implied causal relationship between the June summit and the July, whatever it takes. And I know, for example, that one of your fellow compatriots, Vitor Constancio, says there's absolutely no relationship between those two events. So whatever it takes would have taken place, no matter what was the result of the Eurozone summit. So my question is, how do you think of it in terms of comparing SMP with OMT? Because it's not in the book, but the more I think about it, the more I think there is a narrative to say SMP was exactly that. It was OMT without the June summit. And it kind of worked a bit, but not fully. So what do you think about that?
Well, I don't know what President Draghi actually thought, because he is the one that can answer that question.
Exactly, and he will never will.
Exactly, and he will never answer that question. Exactly. But my feeling is, and after especially this anecdote that I mentioned at the beginning, where Draghi, I think, took that decision as probably the highest expression during the crisis of the political backing of the Euro project. And he said it to Van Rompuy And then this happening a few weeks later, whatever it takes, for me, my interpretation is that indeed there is a link.
Yeah.
There is a link that's not linear, it's not explicit. You will never probably acknowledge this. But the fact that this has given him assurances that he has the highest political backing. Because this was, I mean, this agreement on the single supervisor, giving the single supervision to the ECB. Maybe now we take it as, okay, but at the time, it was something that even many people did not believe. Going into the meeting at the start of the CER summit, I suspect that some people in the room were actually hoping that the decision, that there would be no agreement. And therefore there would be no direct recapitalization by the ESM because that was the link. And then it happened because the dynamics in these summits are such that sometimes it's difficult to anticipate what the outcome will be. But so I think there is a link, but only Draghi can answer that question. Probably you won't.
Exactly.
Okay. We have a couple of questions from virtual participants. So I'm just going to, there are two of them concerning the Commerzbank Unicredit situation, and then we'll also take a question from the job portals. So I'm just going to read them out. The first is from Georg Ringe, a professor at the University of Hamburg. He says,
Hi, Georg.
He says, among the reasons cited by the German government, they say that they might have to bail out Commerzbank eventually, even though it is under control of an Italian bank. Isn't that exactly what banking union is trying to overcome and admitting its failure at the same time? The second question is from, I believe, Per Wiesén from the Stockholm School of Economics.
Hi, Per.
He asked, how do you expect the acquisition of Commerzbank by Unicredit will affect domestic competition in Italy, in Germany, and maybe on the EU banking market level? Richard, I don't know if you want to ask a question. Yeah, okay.
So I will be shorter on this. So in technical term, Georg's question is about group support, right? I mean, if Commerzbank, whether or not it's merged with Hypovereinsbank, so a German subsidiary, whether it's fully owned or not, the German subsidiary of Unicredit, assuming Unicredit, of course, remains headquartered in Italy, which, as you know, is also part of the broader conversation. So will the parent company support Commerzbank if Commerzbank has a problem? Conversely, if Unicredit Group has a problem, will there be enough support for Commerzbank not to be affected by the problem? And that's linked to what as jargon calls group support. So is there a credible binding commitment by Unicredit in Milan to support Commerzbank in Frankfurt? Assuming that's the structure, maybe Commerzbank in Munich, who knows? That would be something, right? But stranger things that have happened, like there's no bank in Frankfurt, for example. This was a big question when Banco Popular Español failed in June 2017. The Portuguese authorities felt that there was a risk that the Portuguese subsidiary of Banco Popular Español would be left high and dry if there was a messy collapse of Banco Popular Español. And in a way, we will never know, because in the end, there was so the scenario that the Portuguese were concerned about is, let's say Santander buys Banco Popular Español, but not the Portuguese subsidiary, and I have a problem, or something like that. I think it was a bit far-fetched, but it was, at least on paper, legitimate issues. Corresponding issue in the current debate is very much spearheaded by the Belgian authorities. Because of their trauma about Dexia and Fortis back in the days, the Belgians are saying, no matter what, we will be the ones having to pay if there's a problem with Fortis for example, a subsidiary of BNP Paribas, and therefore we don't want free circulation of liquidity in cross-border banking groups because we don't trust you guys. And as long as this is not tested, it's a valid, or at least a plausible argument, and that's exactly why in a completed banking union, my view is that the crisis intervention framework should be fully centralized. So there should be no ambiguity as to where the decision resides, including for deposit insurance. So that's why I respectfully disagree with people like Joachim Nagel or François Villeroy-Gallo, who say the best solution for European deposit insurance is a hybrid system with a mix of national and European decision-making. I think if you want the incentives to be compatible, you need full centralization of the crisis intervention framework, which, by the way, is what exists in the US. There is no role for the states in crisis intervention in the US, even so they have a role, residual, in supervision. So that's kind of the answer to Wolf. Now, in the current policy situation, is it credible for the Germans to oppose the takeover by UniCredit because of that concern? My answer is no, because look at the Italian spreads, they're not very high. Look at the German economy, it's not very good. And therefore, the conceit that all the risks are in Italy and all the good stuff is in Germany is just not credible right now. We are in a more fluid and more balanced situation, which means that it is protectionist and, if you pardon my French, borderline racist on the part of Germans to say UniCredit is a bad acquirer just because it's Italian. Sorry for my bad language. Now to pair, what's the competitive impact? Well, in Germany, one way to look at it is the BDB, the German Association of Commercial Banks, has a weird classification where they have Großbanken, Regionalbanken, Privatbanken, and things like that. I never understood what their definitions were. I'm not sure they have a definition, but they say there are three Großbanken, and that's Deutsche Bank, sorry, Commerzbank, and UniCredit Germany. So basically, you go from three Großbanken to two Großbanken. Is that a problem? I don't think it is, given the geographical footprint, but this will be watched by the competition authorities, as it should. What are the dynamics for Italy? In a way, Italian authorities are probably not very happy, but they cannot say it. The reason they're not very happy is that it means UniCredit is even less of an Italian bank post-transaction as it is now. And as I mentioned, it already isn't really an Italian bank because it has more assets in Germany than in Italy, and in general, more assets outside of Italy than in Italy. But they cannot say it because national pride, and there's a kind of male testosterone thing, I guess, or insecurity that makes it attractive to have your bank buying the German's bank. Why not? I think the bigger question in a way is whether there's a bandwagon effect. So now that Arcel has already demonstrated through the market reaction to the announcement that a combination, a cross-border combination can make sense even in an incomplete banking union, will other banks get similar ideas? I hope that the answer is yes, but we'll see. So that would be my answer. Richard had been extremely patient, so I think he should have the floor.
I just want to say I don't see any more questions from virtual participants. So if you have a question, this is the time to submit it. And in the meantime, I'll ask.
I was characteristically patient.
Yeah. What's happening?
Richard Portis, London Business School, and part-time European Systemic Risk Board. So a disclaimer already. One comment, one very precise question, and one disagreement. The comment is on free circulation of liquidity. And we know that despite all the principles and what is actually in law about free cross-border transfers, etc., that in 2008, UniCredit was not able to transfer liquidity from Germany to Italy. That in 2020, UniCredit was not able, was blocked by the political authorities in Slovenia from transferring liquidity from Slovenia to Italy. And that is you know, despite, as I say, all the supposed regulations that should have prevented those interventions. That's just a comment. The precise question should be easily answered, is whether you have any, you commented on Andrea and Ria's views about cross-border consolidation. Have you any idea what Claudia Buch's views are on this? As far as I know, she hasn't expressed a view in general terms, and certainly hasn't about the UniCredit story as yet. But that's a precise question, the answer to which may be yes, or if it's no, it's a brief answer. If it's yes, you can tell me. And the disagreement is about the stress that you put on sovereign debt in the hands of the banks. ESRB had a report that in 2014, I think, from a committee that I serve on, which was effectively written by Martin Helbig, who has rather strong views about banks and sovereigns and so on. And that report was very controversial in the ESRB General Board, which is composed mainly of central bank governors, with the ESA heads and a few hangers on like members of the Advisory Scientific Committee. And eventually it was approved, and it was quite a strong statement along the lines that you've taken, Nicolas. I'm not sure now, I mean, I was certainly in support of it then, but I'm not sure now how I feel about this in the following sense, that if you look at the sovereign exposures of European banks, funnily enough, they're in pretty good shape. If you compare with the American banks and their holdings of government securities and the book losses, if you mark them to market, this is just not the case in Europe. If you mark to market, and this has been done by EBA, there's a very detailed exercise there, which you're doubtless familiar with. The losses aren't there. I mean, they're very small, maybe 100 billion, you know. And that compares, I mean, the American losses are
As we could
10
see.
times, 20 times as much. And so the question is, why is that? And the answer is that SSM has been very effective in looking at the balance sheets. And I mean, I think that's the answer, not sure. But the dangers in that sense of sovereign exposures to the banks may be a lot less than we think, or than is conventionally believed, and that, I mean, you're, I think implicitly or explicitly, that you're saying they are. And you know, given the political difficulties involved here, maybe we shouldn't be focusing so much on that.
Okay, so on your anecdote, thanks for reminding us of the Slovenian story. The German story, actually, we had a meeting here at Center for European Reform where you invited me, or your predecessors invited me to be on a panel with, I don't remember his name, but the head of public affairs at the time of UniCredit. And the meeting was a public meeting, but he thought it was Chatham House. And so this is a bit of an embarrassment for me because I kind of teased him about this story about the Bundesbank, etc. And he said, yeah, the Bundesbank blocked us and we don't like that. And a journalist was in the room, and then it made the cover story of the FT the next day. And then the Bundesbank called UniCredit and said, fire this guy. So he fortunately was not fired, at least not immediately, and I felt really bad. So your story is right, and the Slovenian thing, if I'm not mistaken, was blocked using macroprudential authority, and macroprudential authority is one of the big gaps of this book, because on purpose I didn't cover it because I wanted to keep the book relatively concise. There are a few other themes that are mentioned at the outset that I didn't cover. But I'm not sure one can say that the action of the Slovenian authorities was illegal under EU law. I don't think it was, or at least that theory has not been tested in court. And therefore it raises complicated questions about what is an infringement of the single market and that kind of thing. Borg versus Enria, I have no reasons to believe Claudia Borg has a different view from the one held by Andrea Enria on this issue, and we will know very soon because the European Central Bank has to authorize a bunch of things for UniCredit Commerzbank, and that process is underway. Typically, those decisions, I think, are not made public but by the ECB, but they may be made public by UniCredit. And finally, on your disagreement, let me just comment on that because I think we're talking about two different things. You're talking about sovereign exposures in general. I'm talking about concentrated domestic sovereign exposures. I'm not in favor of a European regulation to limit the aggregate Eurozone sovereign exposures of Eurozone banks. I have proposed a calibration in a paper that Jose remembers for sovereign concentration charges. The calibration I have proposed in practice does not limit the aggregate sovereign exposures of Eurozone banks to Eurozone sovereigns. What it does limit is the concentration in one single country. That problem doesn't exist in the US because the sovereign exposures of US banks are all at the federal level. And therefore, the policy proposals that is in the book and in my earlier paper on this is not at all about the issue you're mentioning. It's about a different issue. And we can discuss the issue you're mentioning, but it's a different challenge. So basically, we're talking at cross purposes here, and I would like us not to talk at cross purposes.
But if you looked at the exposures of Italian banks to sovereigns, how much of that is outside Italy? If you look at the exposures of French banks.
So the answer to your question about Italy is in the forthcoming papers that Julia Gotti, Conor McCaffrey, and I will have published by the European Parliament next month. And it's a very clear answer. The exposures of UniCredit to the Italian sovereign is moderate. So it has about half of its sovereign exposures in Italy. And that has been pretty stable. It's still quite large compared to the UniCredit capital. So it is a risk. And the other Italian banks, their exposure has been gradually declining over recent years thanks to the action of the SSM, but it's still enormously concentrated in Italy. So the home bias is not going away despite the good work of the European Central Bank. And if you look at the ratio of Italian sovereign exposure, or for that matter, for example, Spanish sovereign exposure of Spanish banks to their tier one capital, it's still far too high. By which I mean that it's so high that the sovereign credit event in those countries would kill the entire banking system. And that's not good. So the evidence so far is that yes, Pillar 2 action, in using the jargon by the ECB, is mitigating this problem of sovereign exposures to a limited extent, but not enough to make it go away. And that's why you need regulatory treatment.
I think we have time for one last question from Carsten Nicolas.
Yeah, okay, great, thanks. Nicolas, in your view, what would a crisis scenario actually have to look like that would force decision makers like in the early days to complete this thing? Or isn't the takeaway from the historiography that you provide in that book and from what Jose was just saying, that we're actually looking at a very specific setup at the time, whether it was individual decision makers creating those links, yes or no, specific state of Franco-German relations, architecture of crisis fighting at that time, even, you mentioned Merkel, Schäuble, the specificities of center-right politics in Germany vis-a-vis the Eurozone. Is that, or what would it look like?
So we almost had it, and again, I speak under Jose's control because he was in the room, in early 2020, at the time of the lockdown. Because what happened in early 2020 is that we had essentially a revival of the bank sovereignty circle, even so it wasn't fully there, but also because the memories of the 2012 were present in most leaders' brains. That was a very tense moment. So of course, the ECB was not in the business of compressing spreads, so it only did PEPP. But then the answer was given by the head of state and government, and their answer was not to complete the banking union, but to do the next generation, which was significant. Also something that many people thought could not be done, but they did it. So that's a partial answer to your question, right? Crises always come from an unexpected corner, and the next one will come from another unexpected corner, which means that any answer I may give to your question will be the wrong answer. Now I wouldn't rule out that we get a crisis one day that forces a decision
in this direction, though.
In this direction. But you know, I mean, it's not entirely a way to escape your question, even so it is. The answer is in the conclusion, right? I mean, there's this famous Monet quote. Europe will be forged in crisis, it will be the sum of answers to the crisis. The story of European banking supervision is exactly that. It's Monet 100%, pure, unalloyed. But the euro was not. Because the euro was born with the Delors Committee, and that was not a response to crisis. I mean, it was a response to, you know, incompleteness of the policy framework, but it was a reasoned, economically grounded process of thinking about policy and how we can make it better. And then, you know, you had the end of the Cold War, a number of things that facilitated the decision-making, but the origin of the creation of the euro, which was the Delors Committee, was not triggered by crisis. So I'm saying we can do that. We don't need a crisis. We can do better.
We're approaching the hour mark. I don't see any further questions. So thank you all for participating. Thank you for joining us online. This has been recorded. We will make a recording available on our website shortly.